Here we go. Here we go. Here we go. Hello, friends. Welcome. Gonna get a sound check. If you can hear me, let me know in the chat and we'll fire up the intro. I just always like to make sure first. We've had technical issues. Yo. All right, let's do this. Hello, hello. Welcome, friends, to Alpha Beta Soup. I'm TXMC. It's your boy. And we're here. Welcome, everyone. Good to see you. Smash that like button. Let's get it started early, huh? It is October 26th, 2023. It's 11 a.m. U.S. Central Time. What a last week or two we've had. Crazy. So I was going to do a stream last week because that was the normal schedule, but I've had some family issues going on. We had someone pass away. We've had people coming to visit from out of town. There was a lot going on. So I just pushed the stream back to today. So that's why we're doing it this week and we didn't do it last week. I'm still fully committed to the stream. And in fact, we're probably going to start doing them weekly. But I just wanted you guys to know that's why we didn't do one for like the last 5 or 6 days. It's all good. Thank you guys. I appreciate the kind thoughts and things. It was a very ill member of our family. They battled for a long time, and cancer sucks. You know, I've had a lot of members of my family pass from cancer specifically. So we are well versed in dealing with it, but also really tired of dealing with it. So, you know, that's how it goes. But enough about that. Let's look at what's going on in the market. So much has been going on. Bitcoin absolutely ripped through like a 15-month range up to 35,000, depending on the exchange you looked at. It's up like 30% in a week or something like that. Let me see, make sure my numbers are correct. Yeah, about 30% in a week. There's a bunch of other altcoins that have ripped that much. I think TRB, which is just like one of the random coins that's been ripping all year, did a 10x since like September. It went from $10 to $120. It really feels like as soon as BTC broke that resistance, you know, the whole market was ready for it. At least crypto, right? But the weird thing is that Bitcoin did this. We've seen a lot of alts starting to take off. There's excitement in the space, understandably. But at the same time, you look over at something like the NASDAQ and it's completely rolling over in market structure. Bit of a divergence going on here. And rightfully so, a lot of people asking, well, which market is correct? Well, I don't know that we know the answer to that yet. I don't know that I'll be able to provide you an answer on that, but we can at least look at what's going on, talk about it, try to get an idea of why we think this is occurring. I think a big story for TradFi in general right now is what's going on with long end yields. It's what we've been talking about the last couple of streams, how the 10-year and the 30-year had been breaking up into new highs, into areas they hadn't seen since the great financial crisis, right? This is the 10-year treasury, which is the benchmark treasury for all kinds of global markets. Trillions of dollars are benchmarked to this value right here. And it is touching a level it hasn't seen since the summer of 2007. And it got there very quickly. So what I think is really pulling down equities here is this force right here, which crypto is sensitive to, but not so much, not in the same kind of direct way where you see a lot of portfolios necessarily having to rebalance, positions having to be changed because of 10-year and 30-year yields breaking out. And this relationship you can see pretty clearly if we look at the NASDAQ on the same chart as real interest rates. So real interest rates are the yield, this 10-year yield, minus inflation expectations across the same period of time. So what we're looking at on the bottom is the 10-year real yield. It's the 10-year yield minus 10-year inflation expectations. And It rose through 2022 after being pretty flat for most of the COVID era during the bull run. You see the market climbing here, real yields staying very low. In fact, they were negative. Zero is way up here. But last year, once Powell began his tightening process, real yields began to climb, in large part because nominal yields were climbing, because the first component of this calculation was climbing. Inflation expectations were also higher last year when we had energy ripping and all that stuff going on, CPI accelerating. But what the story has been in 2023 has really been nominal yields, less inflation expectations, and more what's been going on with the 10-year. And what you'll notice, the relationship between these two is interesting. As real yields were rising, the market was falling last year. When the market bottomed in October, real yields kind of topped out. And they went sideways for a long time, for about 8 months, from October of last year until around July of this year. We had real yields consolidating sideways. And during that period of time, equities took off, particularly tech stocks, right? Everything surrounding the AI buzz. All of that took off with alacrity during that period of time. And as soon as real yields started to break out again, which was in July, which coincided with FOMC and with some news coming out of the U.S. Treasury that Janet Yellen was going to have to start issuing a lot more coupons, meaning a lot more duration to be able to fund the U.S. deficit. They weren't going to be able to just keep issuing 3-month and 6-month T-bills. They're going to have to issue some 5-year, 7-year, 10-year notes, etc. At some point, the market saw that, and we've seen long-end yields rising in anticipation of that supply. When yields go up, it's because the prices of bonds are going down because people are selling them. So that's the dynamic that saw real yields breaking out. And this breakout perfectly coincided with the top of the NASDAQ. It's been falling while yields have been ripping. I think that's the dynamic to watch as well over the next few weeks. If this trend here remains intact and we don't see real yields as kind of doing one of these and doing one of these long consolidations like this, if it continues drifting higher, then I would expect this trend on equities to continue like this as a natural reaction to that force. Now, technically, the NASDAQ just looks like shit. I tweeted yesterday that it looked really sus when we kind of had this descending trend line here. A lot of people don't like diagonal lines. They're not gospel at all, but they do help you to visualize the structure and the trend of the market. And yesterday, right when I tweeted this out, this candle wasn't here, right? The NASDAQ looked like this. And you can see the structure here really clearly. For those of you whose eyes don't immediately detect these things, this is what we're talking about. We've got a high, we've got a low, we have another high that isn't as high as this one, so a lower high. This low right here breaks this one, so we have a lower low. Then we come back up and we have another lower high. And then we come down here, we break this level, and we have another lower low. That's market structure 101, people. And it is not favorable to see this dynamic here. When you zoom out, just from like a support and resistance perspective, this appears to be the next level. Right? This was the August high. We had a bit of consolidation here before we broke out higher. And I think this is another maybe 2% down on the NASDAQ, 3%, call it. Roughly about 3% lower on the NASDAQ. That's the next area of support. And then once you get below there, then you're looking down into this area here around the 13,000 or lower. I don't really know what equities are going to do, but when you think about what we were just saying with Yellen and with having to fund the deficits, massive U.S. deficits, which I'll show you a chart of here in a few minutes, that necessarily means that there will be more treasury supply coming to the market. As a result of that, people are selling their existing treasuries. That is pushing yields higher. And that math of yields being higher necessarily is pulling down risk assets. It's pulling down the NASDAQ, it's pulling down the S&P 500, etc. So if we anticipate more treasury supply, which is reasonable to assume, there is a lot of borrowing that needs to happen in this quarter and all throughout next year, another $1.5 trillion, then we have to expect yields will naturally have a pressure to go higher. That's just kind of how the market works. It's supply and demand. If there's a lot more supply, then yields will go higher. And if that's the case, then equities will struggle to rally. That's what we've been seeing. It's been a little bit more of a bad story for the Russell 2000. So the NASDAQ benefited from the large cap leadership. We talked about this in the previous stream, how the S&P and the NASDAQ have been led by market cap leadership. The biggest companies in the index are the ones that have done the best this year, and the majority of the rest of the stock market has been left behind. They have been forced to watch this very exclusive dinner party from outside the house. And you can see that on the Russell 2000, right? Like, let's throw the NASDAQ on here. New price scale. From the beginning of the year, here's the bottom of 2023. Here's where the Russell was. The Russell has gone up, made a high, come down, made a low, made a second double top, same exact level that it was at a few months before, and has now come down and broken below and has set new 2023 lows. You see that? We're now at new 2023 lows. Here was the open of the year. Well, the NASDAQ during that same period of time ripped about 35%. So there's been a massive divergence. And this represents a very small part of the market. Now, in dollar terms, in market cap terms, it represents a very big piece of these weighted indexes of the S&P, of the NASDAQ. They're heavily influenced by market cap leadership. But if we just kind of pull that away and we look at the bottom 2,000 smallest companies in the index, they are screaming in pain. They are having a very bad year, and they are actually at the lows of the year. You see this? They're down in October 2022 area. That is where the stock market bottomed last year, right? I mean, we were just looking at the NASDAQ. That's the low. That's the low back here, Q4 2022. Same thing for the S&P. Put the S&P on here. New price scale. Let's turn off the NASDAQ. Here's the bottom of the S&P. The middle of October 2022. This is right before the 3-month 10-year yield curve inverted and really began our recession modeling process that we've been going through on this channel. But that's where the Russell is now back to. Look where the NASDAQ is. Look at how differently these two indexes of the same exact stock market are showing each other right now. They're very diverged. And I think that it's impossible to anticipate a consistent, sustained bull market uptrend. Even if you recognize this pullback, if you're still bullish on the market over the next 6-9 months, I think that it is straining the fabric of logic to think that we would continue to see large caps diverging this heavily from the bottom majority of the market. You can see this same dynamic if we take off the S&P, take off the NASDAQ. What are some other things that look pretty bad? Corporate credit. Here's high yield corporate credit. Let's look at investment grade corporate credit, which are more credit-worthy businesses. Look at this. This is all the way down at the lows. This is investment credit. This is businesses and their desire to issue debt to fund their operations and things like that. And you can see demand for that is falling off. This is an ETF that represents corporate bonds. It's completely fallen off a cliff. It fell most of last year as yields were rising, but then this year has really struggled to gain any footing. And the dynamic is concerning because if you go back and you look at when bull markets began, really you can look at any time that the S&P drew down 15 to 20% or more, and then it found a bottom. Every one of those bottoms was joined in tandem by things like this, by corporate debt, by the Russell 2000 that we were just looking at, and the S&P and the NASDAQ and the larger indexes. All of them bottom at the same time and lift off the lows at the same time. However, that's not what's going on in 2023. We've got everything except the, call it, 20 largest companies in the United States. With the exception of those 20 companies or so, everything else is struggling mightily. And it creates a lot of distortions, right? Because this number, this S&P number, is the number that everyone hears about for the stock market. As it was climbing this year, while something like the Russell 2000 was not, that people didn't really notice that, right? Folks who are really tuned into the market, they knew. But the average normie, investor, casual person who just puts money into their 401k and hears about the news on CNBC, like that person just kept hearing that the S&P and the NASDAQ were climbing higher. Those are the numbers that are in everyone's 401ks, right? That all the index funds are tied to the S&P and to the Qs themselves. And so as those values rose, but other components inside the market showed weakness, it created an illusion, I guess, for lack of a better word. And I think that that's partially fueled why we've had so much bullishness, even during a period where there's ample reason to be cautious. I got an alert on ARK. Let's go see what that is. Oof. You can see ARK breaking below. I had an alert set here for ARK to see when it broke below these lows that it set in March and May, and it looks like it's doing that now. Of course, this is an absolutely dead stock, but I just wanted to come take a look at that. So the market is going in a couple of different places. We've got Bitcoin climbing higher. We've got a lot of altcoins that have moved higher, but we've still got this weird weakness over in TradFi. A lot of people have been asking me if I think that Bitcoin is going to diverge from equities and going to go on and have its own story. And right now it's kind of doing that. And it can be seductive to want to believe that Bitcoin, because it's an outside money, because it's a little different from any other asset that we've had before in the sense that no one's really in control of the supply, because it has these unique properties, it's really seductive for people to begin to believe that it is capable of acting differently from all other assets in the world. But that's not really the true. That isn't really how a market functions. And when you think about how people buy an asset, they buy it with the same dollars they're buying everything else, right? And the conditions of Bitcoin are heavily influenced by the denominator. The denominator is the US dollar. So all markets are related to each other in a way, and they all behave in kind of similar fashions. They have different correlations. They may move at different times and have betas, have more volatility than each other. But there is no single market that just ignores the rest of the world and goes on and does its own thing for extended periods of time. Those are called dislocations, and they're usually very brief. And oftentimes, they end by a reconvergence of the markets. So I'm not sure that we can really look at BTC and say, oh, it's sound money. Everyone understands that central banks will have to print eternally, so it's just going to go up forever. That's not really how it works. It's also one of the most liquid assets on earth. It is global. It's borderless. And whenever you have people in financial stress, liquid assets are the first things that get hit, right? Same thing with gold. So that's another component. And we haven't really seen the kind of margin call liquidation style environment that often arrives late in bear markets. That hasn't really manifested yet. Maybe we're starting to get close to that, as some people on my Twitter feed seem to think, but we haven't seen that yet. And there's another element of this. So my friend Blockchain Backer, he and I talk quite a bit, and we were talking about this chart recently. This is the tech sector of the NASDAQ, and I believe he's shown this on his stream as well. So if you watch his live streams, you probably have seen him talking about this. And this part of the market here, specifically the tech companies within the NASDAQ itself, they have a pretty close relationship with Bitcoin. They have historically had a pretty close relationship with Bitcoin. When Bitcoin isn't doing so well, the tech stocks in the NASDAQ aren't doing very well, and vice versa. And you can even see, look, These two topped at almost exactly the same time in November of 2021. But during this year, they began to diverge a bit, and it was in favor of the NASDAQ, in favor of those tech stocks. They had a much stronger move up into their retracement levels, while Bitcoin has been hanging back a bit. So let's look at this on two side-by-side charts. So we got the tech sector, the NASDAQ over here. On this side, we'll put Bitcoin. Okay. So one thing that I think is interesting to look at is when you look at where the NASDAQ tech sector is this year, it has pushed all the way up into its retracements. And if you see, it's actually at the 702 retracement, which is a bit ominous if you're someone who understands the importance of these retracement levels right here from the 618 to the 786. This is usually the place where a market will roll over and a trend will begin to reverse. So we want to see this get broken above if we're bullish on tech stocks and the market broadly. But concerning that it's pulling back at the 702 retracement and now breaking below the 0.5. But Bitcoin is nowhere near this level of retracements. Nowhere near it. It is all the way down at the 382. It's as if the NASDAQ was right here. Right? This is where Bitcoin is. Look, breakout, consolidation, break up, consolidation, now breakout. It's doing one of these right here, right underneath the 382. This little motion is very similar to what Bitcoin's done all year long. Well, the NASDAQ did that in about 3 months at the beginning of the year and then took off. Right after the bank crisis and everything, and the bank term funding program came out, Signature Bank went down, Silicon Valley Bank went down, and then the market realized that the Fed was going to backstop depositors, and everything took off with AI hype fueling it. Well, Bitcoin might be trying to catch up, in a sense, to what the tech sector has already done this year. Now, I don't necessarily think that Bitcoin's going to go all the way up into this area, all the way up to 53,000, which is what this would mean if it was going to do exactly the same thing as the NASDAQ. But what I do think is that now that we've finally cleared this long-term consolidation right here, it makes a lot more sense that if we're able to maintain this trend, if this isn't just a liquidity hunt to go right back down and go lower, if this is actually going to hold, then I would anticipate price action getting up into this area here, getting up into the high 30s, getting close to 40,000. And that's the real danger spot. Anything really over this area here, over like 40K, is really dangerous because we've already got the tech stocks having hit their retracements. If you look at a bunch of the tech names inside of here, they look really toppy, right? Like here's Microsoft. Oops. Sorry, fumbling my buttons a little bit here. Here's Microsoft, broke down, set a new high, sharply pulled back. It tried to break up during earnings the other day and just sold right back off down into the consolidation it was at before. This one looks a little toppy. Apple looks kind of similar, right? Breakout, pullback, another high, sharp drawdown. Even if you look at like Berkshire Hathaway, it's starting to look kind of the same, right? These are big companies. These are the companies at the top of the stack on market cap leadership. Look at this, breakout, sharp pullback, second high, pulling back sharply. What does this remind you of? Does this remind you of Bitcoin? It did the same thing in 2021, did it not? Big high, sharp pull down, second high that just goes a little bit above it, and now it's breaking down. Now it's breaking down over here on the Berkshire. Like I said, the Microsoft's looking like that. Apple is looking like that. Amazon has already topped. Google is doing something similar, but it hasn't broken up and made a new high yet. It's actually in its retracements. Let's see where this is. Well, it got above the 786, but then look at that sell-off, right? It's a huge rejection at the retracement levels. So maybe what we're seeing now is Bitcoin finally putting in a retracement of some kind. because it hasn't done that this entire bear market. If we rewind back to before the Luna crash and we think about where we were back here, this moment right here is the best retrace that Bitcoin has had in this entire bear market. Right here, right before Luna collapsed in the late March of 2022, when it got above the 382, got up to about a 40% retracement or so, and it rolled back over. We know what happened after that. But if we now apply this same retracement tool to the low from FTX last year, we can see we're getting close to that 382 level. And so if we get above, like, eyeballing it, if we get above kind of right here, which let's just call it 38,000, we get above 38, we will have retraced more than Bitcoin has at any other time during the bear market. So maybe it's trying to do that now. Maybe it's trying to do what tech stocks have already been able to do this year. So that's something that I'm watching for. I think that the odds of it are significantly higher now that we've finally gotten out of this area. Now, maybe we come back and test this as support. We haven't done that, right? We've broken cleanly above, and it is logical and rational to assume that price would want to find out if this is indeed support. So don't be surprised if we start to pull back and we start to see 32,000. Maybe we see a 31 handle again. Maybe you see a 30 handle. But because of the amount of time we spent here, and because this breakout has not immediately come back down, I think that there's a reasonable argument to be made that this could turn into support, at least for the time being, and we could finally start to drift higher back up into this range up here. That's kind of what I've been looking at. And for you guys who've been following me on the stream, we've been bullish, right? I know that I talk a lot about recession, and I'm bearish on the economy over the next couple of years and the likelihood of us starting a long-term, sustained bullish uptrend. However, that's a different time frame from being bullish on Bitcoin right now and maybe through the end of the year for the next couple of months as this continues to play out. And for those of you who remember, we were bullish here, right? We had a live stream right in this area, somewhere right here. And we were talking about how on Coinbase, this set a higher high. Let me zoom in. This set a higher high. It completed a crashing structure on the daily chart and on very low time frames. There was a very low time frame crashing structure inside of here, while there was also one on the daily. And both of those made us bullish right here. Bullish to at least return back to range highs at some point, right? And we've done some basic TA on here where we've marked out some levels. And one of those key levels at first was this right here, right? It was the Luna wick. That was one of our key levels. But then also it was right here. I drew this line for you guys on the channel. I think it was blue at the time. And I said, if we can hold this, I'm bullish as long as we don't break below 24.7 right here. Well, we didn't. And I think that if we're going to hold this as support, the next area is up. I think I marked a level around here, and then I marked this blue line. Well, we broke through that one, broke through the first one, and now we've broken through the second. Maybe we come back, maybe we find it as support, and then we go higher. That's what I'd like to see. I would love to see that. And if we get that kind of a move, then I think that it could be an exciting time for people who trade altcoins, because this is what I think is the most likely scenario. This isn't so much of a forecast. It's just, based on how things usually happen and based on what I think the economy will support happening in risk assets. Then let's just play out a scenario here. Let's say Bitcoin comes back, it tests this, and then it goes up for another leg. And it gets up here to maybe like 40,000. And then it really just kind of starts flagging a bit because there's a lot of supply up here. It's a big round number. It's into the retracements. And if it starts to flag like this, considering we've already seen so much strength in altcoins, then I think it's possible that if we're in this zone right here, that we could start to see a bunch of little altcoins start ripping like this, at least back up closer to their own March, April, May 2022 retracement areas. I think that's a logical dynamic to expect. That's the kind of rotational thing we normally see in the crypto market, right? You see Bitcoin move higher, and then as it consolidates and loses some strength, capital rotates into smaller plays, expecting them to follow along in the footsteps. So that sets up for the possibility of that happening there. But, you know, that would be getting into the danger zones of the retracements. If we get all the way up into here, if we get all the way up to like the 618 or something, that would be a huge move. I don't think that one's as likely to manifest anytime soon, but I do think that we'll have some chop and some churn if we try to get up into this area closer to 40,000. And if Bitcoin slows down, if it breaks higher and then slows down, I think that will get a lot of people's attention. And there have been enough people sidelined because of all of the bearishness, because of what's been going on in equities, because this is the first real Fed tightening cycle that crypto's ever really endured. There were a lot of people who just didn't believe that this move could happen right here, right? I mean, I'm not one of these TA fractal wizards who is able to compare every move to everything that happens in the past. You know, my buddy BC Backer, he's really good at that. There are other people on Twitter who do that kind of thing. But it's just, whenever you have a move like this, when you have this much consolidation, and this was a 15-month window of time right here where we were not above 31,000. And you had all of these people calling for us to break below this level and to go down lower to test 20K again, or to test 14K, or to test 12K, or whatever. There are so many of these guys that didn't go long for this move, that if Bitcoin does one of these bounces and even makes another high and gets up into these areas and then starts flagging, all these people are going to feel FOMO like a motherfucker. Sorry if there's some thunder coming through the mic. I don't know if there is. It is storming really badly here where I live, so hopefully the power keeps going. But anyway, I just think that we're in a kind of an interesting spot where a lot of people who watch Bitcoin maybe weren't anticipating this kind of breakout. Hopefully they added to their long-term spot bags during this period of time. I would hope that people did that. But for the traders, for the speculators, for the people who get in and out of positions and who actually move price around, a lot of those people were not ready for this breakout to happen this quickly, especially after we got that fake out. That fake news it was right here, I think, when we got the fake ETF news like a week ago. I think people were just figuring we were going to get another one of these, right? It was just going to be another Bart Simpson, rip higher, then drop all the way back down, complete fake out. And instead, it took off without them. And we had this massive squeeze. It went $5,000 in a single day. So that creates an opportunity for strong emotions to be felt. And I think that could provide some fuel if we actually start to act like this blue line of support. Who's BCB? BCB is Blockchain Backer. He's a buddy of mine. He's on Twitter. He makes YouTube videos. A lot of my audience knows who I am thanks to him. So I bring him up sometimes because we're friends, and he's the guy that I usually chat about markets with on like a daily basis. It's good to have a friend like that. I've said this before. All of you who are currently in this market, you really should try to find a person or a very tight-knit group of people that you can share ideas with. I don't mean sharing trade entries with necessarily. I mean talking about the complexities of the market, because you need friends who look at things differently from you and who look at different things from what the items you find interesting, right? Who follow different parts of the market, who use different indicators to get their bias. You need some people like that. They don't have to be ace traders. They don't have to be super experienced financial experts. They just need to be a rational, trustworthy person that you can bounce ideas off of, because these markets can be really lonely. And if you're someone who forms a particular thesis and then it begins to be challenged by market action, it's really helpful to be able to bounce your ideas off of somebody else and be like, hey, I thought that we were going to hang around in this area, but now I'm seeing it break higher. I don't really know what to think about this. What are you seeing? Do you see anything that would justify why this move is happening? Do you agree with me that it shouldn't have broken out here? Like whatever, right? You just need to be able to talk about those things with someone. So that's a really valuable piece to have just in your toolbox as a market participant. One thing I wanted to check on was the DXY. This Wyckoff spring was a big catalyst for us recognizing that we were probably near the end of the rally in equities. This also, similarly to the breakout in real yields that we looked at earlier, I must have taken it off of here. We noted that the top of the NASDAQ here aligned with the breakout of real yields. We talked about that at the beginning of the stream. It was also the Wyckoff spring of the DXY that took it all the way back up to 107. So a lot of things were confluent right at that period of time. And if we look at where the DXY is now, well, we kind of had this long phase here, this Wyckoff accumulation. We sprang, we've shot up, and now we're bouncing along the range highs. And if we look at a Wyckoff schematic, let us throw this on our chart here. Well, doesn't it kind of look like we're right here? Oh, that's in yellow. Let me make this in like red. You can see that better. Yeah, that looks better. Like, follow along with me here, right? We got the SC. We shoot higher. We come back down. Secondary test in phase B. Come up for some more consolidation. Down into the spring. Here's the spring. We shoot higher all the way across the range, and then we are consolidating, sign of strength, consolidating right above the range highs. Boop, boop, boop. Boop, boop, boop. That's a little sus. It's a little sus, homies. And if we kind of map out levels here, there's what, at 107. What does that put the next level at? The next level is basically 108, 107.993. Call it 108. And then after that, you're looking at 109.5. If that's true, if this is exactly what this appears to be, then the DXY is not done with this move yet. And there's a high likelihood, as we can now see from it setting a higher high, or setting a higher high on the last few days, it's trying to bounce up, right? It's trying to go back higher again. So I don't think that the DXY is quite done yet. The rapidity of this move is likely over with. The majority of the move has been captured, but it looks like maybe we get up here into the 108s. Maybe we test this wick. Hell, maybe we even get up to 109. And if we look at this on a high time frame, that's a bit of a fair value gap. That's what we call that right there. You see that? It's an area on the price chart where there's only one candle body and there wasn't really any other consolidation. Well, if price starts to get close to that spot, which is at 108, that's the level, it's at this wick right here. It's at the same spot. If it starts to get up into this area, then I would expect it to close this gap. At the very least, to close the gap and to go hunting for this wick right here, which is 109.5 on the DXY. That's just basic gap filling, fair value gap closure kind of stuff on technical analysis, right? So that's what I think is likely there if we're right about this Wyckoff thing that we were just looking at here together. Looks pretty convincing, doesn't it? Doesn't that look the same? And recall, friends, listen, I am not a market expert, okay? I'm just a guy in my office at my house trying to figure this stuff out. I'm learning every day, learning new things. But this looked like Wyckoff accumulation to me. And when we were down here, there were so many people, really, it was like this. When the DXY was like this, there were so many people that said we were about to start the new bull market, right? And that we had already begun. Right? AI was leading the way. And if you look, this was the NASDAQ. The NASDAQ had gone straight up to this moment. And everyone told me that DXY was going to 90. You know, I posted about the Wyckoff accumulation, and there were multiple people in the comments telling me I was an idiot, telling me that it's going all the way down here. And they were wrong. And the only way that I identified that was by ignoring everything people on Twitter said and just looking at this one chart and saying, okay, what is this one chart telling me? And that is how I identified the pattern. And it ended up being correct. And it flew in the face of the majority of narratives at that time. So I think that that is an important lesson. I know it's an important one for me. And so I'm making a fine point of it for those of you who are, like me, still learning, still trying to figure out how to be a wizened market participant. The narratives follow the price. The narratives do not lead the price. And so whenever you see a chart going strongly in a particular direction, people will come up with reasons for why it is happening. The same thing happened just the other day on the 10-year. So we're sitting here on the 10-year, and it goes up and it touches 5%. Look at these candles right here. So the 10-year yield goes up and it touches 5% for the first time in like 13 years. And then it sells off sharply. The yield's falling, meaning that there's a bid. It's not a sell-off. Sorry, that's the wrong word. The yields fell sharply, which meant that people bought bonds here, right? This is the inverse of the price of the 10-year bond. Let me see. One here. This is it. 10-year T-note futures. I'll show you. So actually, yeah, I don't want to confuse you. I just want to make sure that I'm showing you what I'm thinking about here. So TradingView. New pane below. Yeah. So this is the price of the bonds. It falls while the yields go higher, right? And in this moment right here, you see the price shot up, the yield fell right at 5%. The first time it had touched 5% since all the way back here in 2007. And when this happened, there were so many people on Twitter, like FinTwit types, crusty old boomer types, who they saw that and like, oh my God, what does this mean? Has there been a change in the bond market? Is this happening because Bill Ackman covered his short? Is it because institutions are doing stuff, blah, 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 coming up with narratives, right? How about it was a technical bounce off of a major round number that it hadn't seen in 13 years? Like, that's the reason. We don't have to come up with a story. The chart told you that that was an important level. We hit it. It hadn't been seen in ages, and a bunch of positions reacted to it. That's the same thing as Bitcoin bouncing off of 50K. Like, psychologically, that's the same exact thing. Large round numbers cause reactions, particularly when they haven't been seen in a long time. And the reason I bring this up is not because of some major lesson about the 10-year. It's to bring up the concept that narratives follow the price, right? The price hit a technical level. It created a technical reaction. And then humans, seeing that, went searching for explanations. It's the same thing when Bitcoin does a big fake out move like this right here. Not a fake out, sorry. When Bitcoin just does a big move like this, people start looking for explanations. Well, what does this mean? Is it because BlackRock is loading up on Bitcoin in anticipation of the ETF launch? Why do we need that narrative? Why do we have to come up with something that's incapable of being proven true as some kind of a way to explain what is otherwise a perfectly rational technical breakout of a 15-month range? That's why it broke out. Because you have positions gathered atop this level for months on end. And when it finally breaks, they all have to close, right? It's the same thing that happens at the lows when you sweep a low and then you shoot higher. It's the same thing. So the narratives on Twitter can really throw you for a loop. They can really get you all twisted up. And Bitcoiners are just as guilty of that as people in TradFi. which is why a lot of the times I don't go along with what people are saying on Twitter. You know, you guys who followed me for a long time, you know that I'm kind of a contrarian. I don't go out of my way to be one, but when I hear people telling me a reason for price doing XYZ, I'm initially skeptical because people are often dead ass wrong about those things. And in many cases, if you just go look at the chart provided you with a perfectly rational technical explanation for a thing playing out that doesn't need a human story attached to it. Most of the time, the human story is not relevant. So I tend to not listen to narratives. I tend to push them aside, not really give them much credence. You know, sometimes I like to find some color commentary on a big trend. You know, if we see a market moving in a particular direction for several weeks or months, there might be more behind it than just a technical move. It might be some other things are now starting to take place that were kicked off by the technical reaction. Right. So it's very complicated, but the stories are not what leads the price. The price creates the stories most of the time. So wow, we've gone for 45 minutes already. Incredible. I'm going to stop here. I'm going to scroll through the chat and I'm going to make sure I haven't missed anybody's big questions, any super chats, any stuff like that. And then we'll look at a couple more things before we start wrapping it up. Do I know that? Cash Me Outside. Did you know the number one way to support Alpha Beta Soup is hitting the like button? Yes, smash that like button. We've got 267 viewers. We have less than 200 likes. That means that there are about 100 of you that I still need a button click from. Click that thumbs up. I'm out here sweating, putting in work. That's all I need from you. Rodrigo, thank you so much for the super chat. Very generous. Can I do a summary on critical indicators for a recession and how I'll be prepared for it? First surfing crypto and then shorting the market. So as far as critical indicators for recession, we've done a video series on Alpha Beta Soup. I say we, it was me. I did a video series on Alpha Beta Soup earlier this year. Where I actually walk through the indicators that the NBER uses to determine whether or not we have recessions. And then we have ourselves modeled them out in many different ways over the last few months to try to determine for ourselves how to assess this economy using those indicators and several others that we have deemed important. So the place that I would say to start, youtube.com, is go to my channel, Alpha Beta Soup. Go to playlists, and right here you'll see one that's called Recession Roundup, Anatomy of an Economic Downturn. And I don't mean to play that. This playlist has 4 videos on it. 1, 2, 3, 4. And this is the beginning of what has become my fairly well-known now recession modeling that we've been doing for most of this year. That was my introducing the audience to it. So if you really want to go down the rabbit hole, I would say watch this first video. And if you like it, you can keep going with the others. But the first one introduces you to the indicators that I think are important for watching the U.S. economy, right? Less about the stock market, more about the economy. What we know about risk assets is that they can perform well until an economic downturn becomes obvious. And the period at which it becomes obvious to market participants is usually quite late in the cycle. So if we think back to the great financial crisis, let's look at that on Fred. Let's look at unemployment. Actually, no. We'll do it with the S&P. We'll add recessions. By the way, this indicator right here that says recessions and has my name TXMC next to it. If you're on TradingView, you can also use this indicator. Just look for my name, go add an indicator to your chart. And if you type in TXMC, you'll find a few of them. Some of these are not published. I have my name written on them, but they're mine. But I have published 2 or 3 of my scripts. You see them down here. And one of them is recessions. The other one is the 10-year, 2-year Treasury yield spread, the yield curve. So you can use this if you want, and it just slaps them on the chart for you for easy viewing. But what I wanted to look at was the market related to recessions. So the Great Financial Crisis, I think, is a good example because it was a pretty big recession. I think the odds of us having a pretty big one are elevated, and it's the most recent one. So I think it's a good one to look at. And what you notice, there's a couple of nuances about this to be aware of. So this period here where you see this bar start, that is when the NBER, which is the committee in charge of determining these things, said that the recession began. They said it began in December 2007, January 2008, right around the turn of the year. But it doesn't mean, and I've said this to you guys before, it doesn't mean that someone goes on the TV and says today is the first day of the recession. No one waves a big flag. There's nothing that makes it obvious. It's always dated in hindsight, and they try to find kind of an equilibrium moment amongst those indicators that they follow that I told you to go watch my stream if you want to learn about, or watch my playlist, my Anatomy of an Economic Downturn playlist if you want to see that. They kind of find a spot and go, okay, we think that's where it started. And for them, it was the beginning of 2008. But what you'll see is the market didn't really recognize that it was a recession until summer, right? We had unemployment. Let's see if we can slap unemployment on here. Unrate. There we go. New pane. Unemployment had begun to rise. The low for that cycle was around 4.5, and you can see it was drifting up really slowly in the last few months of December 2007. This is also when the Fed cut rates. They cut rates right here before the recession ever began, when the market was still near its peak. Let's slap Fed funds on here too, a third one. You see this right here? This is when they started to cut. August, September 2007, they started cutting interest rates, unemployment started drifting higher, and the market was still at its highs. But once unemployment really started to tick up in the summer, the market recognized that the economy was probably going to slow down. We had Bear Stearns go out of business in like March and April, and then in September, Lehman Brothers collapsed, and that's when the floor just fell out. That's when everyone realized, oh shit, this is the big one. We had unemployment really begin to spike. Like I said, the markets rolled over, and the Fed had been cutting that entire time, right? The entire fall of the market in 2008 was during a period of falling interest rates. The Fed cut the entire way down. So that's kind of throws cold water on anyone who thinks that as soon as the Fed cuts, that's necessarily bullish for us. It isn't necessarily bullish for us. A lot of it depends on the context of why they are cutting. So keep that in mind. But markets can perform well up until right when the recession hits. And so it can be really difficult to try to time these things. I think that if you're someone who is concerned about this happening, that you should already be positioning yourself in some way, right? If that is a concern for you, if you have a bunch of exposure to risk right now, then maybe you need to go through that process, which I've talked to you guys about before, where you think about, okay, these are the things that I own. This is where I got into those assets. These are some prices at which I might consider selling some of these things if they ever get there. If they begin to break down, these are some places where I might consider rotating out of some of my stocks or some of my Bitcoin or some of my whatever that you have, my gold, my collectibles, whatever you've got. You've got a bunch of assets. Everyone has a different collection of assets. They all have some price on them that they are worth to you. That price might be ridiculous, but there is a price. And you should go through the exercise of what you will do if you ever find yourself in an environment where the next few months suddenly look way less certain than they do. Even now, in the environment that we're in, it isn't obvious that we're going to have a recession or that we're going to have a lot of unemployment or that the markets are just going to collapse. We're just in a place where the risks are extremely elevated, right? We're in a place where historically those things have begun to happen. So you have to be aware and go through the exercise in your own mind of what you're going to do with your assets. Because when we go through one of these periods like this, initially, nothing does well. There isn't something that you buy like right here and it moons while everything craters. There isn't that kind of a safe haven. But what you can do is balance out your exposure, have some cash, have maybe some bonds or some kind of yielding assets, have some risk, have some Bitcoin. You need to figure that out for yourself. I'm not going to try to give you the answer because I don't even know if my solution is the best one. I just went through that exercise for myself. I'm taking ownership of my assets and my positioning in this market, and I'm going through that mental exercise of what I'm going to do. And I encourage you to do that as well. Most people don't do that, or they wait until shit hits the fan to go through that exercise. And what I don't think that any of you really should do is wait for a moment like this. When you get to a period like this, things are happening so quickly that you will not be able to rationally think through what it is that you'd like to do. You don't come up with an emergency exit plan from a burning building the first, when the building is on fire, right? There's already signs on the wall that tell you how to get out of the building safely, right? Go this way. Here's the stairs, right? They've gone through that process. It's the same thing for you. You don't want to wait until the entire market is on fire to find the fire exit. You want to have already identified it, to figure out how you release it and how you're going to climb down it. Just go through that thought process, for yourself. Someone says the Russell is imploding. Did it do something new, or are you just talking about in general? Let's go look at it. Okay, it's basically where it was. All right, I'm going to keep scrolling the chat here. Markets in the afternoon with Alpha Beta Soup. That's right. William, thank you for the super chat. I really appreciate that. Very generous. BCB, you the man. Thanks, bro. I love that. Thank you so much. You guys are very generous. Thank you for donating at all. You don't even have to do that. Sick Thinker, I appreciate the super chat. I see you in here all the time. Appreciate you. All right. There's a couple other things we could look at. We're coming up on an hour. I'm not going to go to an hour and 30 minutes today. We've been subsequently, with each stream, we have been cutting them down a little bit at a time. And I'd like to get this one less than an hour and 30 minutes. And then we will do another stream next week. Okay? We will start trying to do these weekly. Not trying, we will. We will do these weekly. So we'll do another one of these next Wednesday or Thursday. I think those are like the best days to do it. And I will send a link out 24 hours in advance, just like I did today. And I think sometimes it's hard for me to know what to talk to you guys about because we've been waiting 2 weeks between streams. And there's so much going on, right? Like I want to talk about crypto. I want to talk about the stock market. I want to talk about the economy. I also, like to just kind of pontificate about ideas, about being a market participant. And it's hard to fit all that stuff into a stream every 2 weeks. So I think if we do them every week, but we keep them the same length, about an hour, that we can make a lot more room to talk about things in a more fresh way, and I don't have to try to cram it all in. So how's that overnight reverse repo look? Yeah, I guess we can go look at it. Overnight reverse repurchase. Yeah, overnight reverse repo absolutely plummeting. It hasn't really gone anywhere in the last few days. But it has been dropping pretty precipitously. It's dropped about 50% from where it was in April. So at this pace, it would be empty by next April. And the dynamic here, to just be aware of, you don't really have to know everything about the reverse repo. I know a lot of people want to know a lot about it. It's not something that you and I can put our money into. It's a place for money market funds to put cash overnight to get at the overnight rate, which is about the same rate as treasuries. And it's just money deposited with the Fed. And as long as this money is sitting in here, it is not being spent elsewhere in the market. It's not going into risk assets. It's not buying treasuries. It's literally just sitting in a pool at the Federal Reserve getting the overnight rate, which is, if we look up award rate on Fed, the overnight rate is 5.3%. So to round the rate, it's around what a T-bill is. But it's an overnight rate. It's even more liquid than a treasury, and it's directly from the Fed. So in a lot of ways, it's like the most risk-free of all the rates if you are an entity that can use the reverse repo. Only so many entities can. But it was collecting money through 2021 and 2022, and it had, over $2 trillion sitting in here. And what has happened over the last few months is, as Janet Yellen has been issuing short-dated debt, so T-bills, like 1 month, 3 month, 4 month, etc., treasury notes or treasury bills, as she has been issuing those, money has been coming out of the reverse repo to buy that debt. And this is essentially acting as a funding source for the US government. And the thing to be concerned about is that in 6 months, we have depleted 50% of this funding source. There's currently about $1 trillion left. And next year, I think there's 1.7 trillion in borrowing coming from the US government. So this will eventually hit zero. And when it does, some other marginal funding source will need to fill the void and step in and buy the treasuries that these dollars are leaving to buy, or the release valve will be yields, and yields will go higher. That's the dynamic. So as long as this is falling, and we've already seen yields rising, right? We've seen yields rising because of the sheer volume of treasury supply that has to come to the market. And when people see that supply coming, they sell their bonds, and that makes the yields go up. But we've got this funding source here that is currently buying as much of the US debt as it possibly can. And if this gets back down to zero, as it was not that long ago, I mean, it used to be at zero. If it gets all the way back down to zero, and we've still got the government running $2 trillion deficits, then that money has to come from elsewhere in the market, or yields will go higher until it does. So that is a natural upward pressure on treasury yields at this current time. And it's just something to kind of keep an eye on. And once this goes to zero, that pressure will become stronger, because right now this is almost like a tamping down on the yields, just a little bit. It keeps them from really blowing out, because this is latent demand for those instruments. And, the deficits, people talk about the deficits a lot. I just want to show you guys how bad it is. So this is this little chart of all these bubbles. Each one of these circles is a year. And this goes back to, I think, 1900. Yeah, 1900. This is the federal deficit for the United States from left to right. As it goes to the right, the deficit is getting larger. Right? So they're spending more than they are taking in. The y-axis from bottom to top is the unemployment rate. Typically, as the unemployment rate goes higher, deficits get larger. Usually that's the dynamic, right? And when we're in an economy that's powered by consumption, that makes sense. If people lose their jobs, they lose their income. They are less able to consume. GDP falls. The government spends to fill the void, to support society until it's able to recover. That's just, in layman's terms, that's kind of the dynamic. So what we've seen in the past is typically when unemployment, the y-axis, is very low, we don't have huge deficits, because it means we have full employment and the economy is healthy and things are going well. And the deficit tends to kind of stay in this 0 to 2 to 3% of GDP range. That's where most of it has been. You see this huge cluster of dots right here. But there's some other eras where it has diverged. So one of those is the Great Depression. That's these blue dots. You can see these all the way up here. That's when unemployment was in the 20s. And we were running 4 or 5% deficits, 4 or 5% of GDP. That was in an effort to, recover the economy. It was as a result of Roosevelt's New Deal and a bunch of his policies to help kind of rebuild the economy after the Depression. And so we saw this dynamic up here. During wartime, so during World War I and during World War II, these green and red dots, we had very low unemployment. So you can see the dots are not high on the y-axis, but they're very far out on the x-axis. They're out here to 10, 15, 20% deficits to GDP because we were in wartime, right? That makes perfect sense. But fast forward to today, right? These black dots are today. We are at a period of time where we have record low unemployment, right? Unemployment low for this cycle was 3.4%. That's about as low as it has ever been, just about, with the exception of a couple periods in the early part of the century, last century. So we've got record low unemployment. We are not currently in the middle of a world war, yet we are running these massive deficits. You see these dots? These 4 black dots have completely separated from this basically 120-year cluster of normal deficits over here. And so if we are running 6, 7, 8% deficits to GDP in peacetime right now, what does that mean for government spending if we have an actual downturn? How much room is there for the government to fiscally support a downturning economy when they are already basically spending at max capacity and there are questions about who will fund all that debt, right? We were just talking about the overnight reverse repo and how this is currently funding the US government. This is the marginal source of funding. There are countries who buy debt, etc. There's pensions and things who buy the debt. It's not only the reverse repo, but this is currently the most obvious marginal source of funding. And we have these massive deficits in peacetime. So if we actually have a recession, it's rational to assume that we will see these deficits down over here at double-digit percentages of GDP, and we won't have a world war necessarily happening at the same time. That's hugely concerning. It makes you wonder just how much fiscal space actually exists. And when you think about the political turmoil currently in Washington around the deficit and how you have a lot of Republicans voting against things like sending more money to Ukraine, there is a political rift over the deficit right now. There is not a unanimity, an agreement that we need to spend for XYZ reasons because it's good for the economy. They are not at a consensus in Washington. They are, in fact, extremely divided on this topic. It's part of the reason why there is no House Speaker in the U.S. right now, because the last Speaker was booted for working with the Democrats to help continue the operation of the government, which the Republicans largely are fighting over. So not to get political about it, but that is what's going on. I don't care between the Democrats and the Republicans, but that's what they're arguing about. So if we actually have an obvious recession, I don't think that it will be a very smooth transition towards recovery spending from the government because we already are spending so heavily. Our interest expense is already larger than the defense budget. So that's not a position that the U.S. has ever been in before. We've only been in these situations with these kinds of deficits in wartime, in World War I and World War II. Those are the only times where it was even remotely comparable, and for one single year of the GFC, right? But and you can see the only other times we even have circles around here are in the recovery from the aftermath, right? Here's the GFC. Well, here's the next 3 years. Here's World War II. Well, here's 1946. So you can see it takes years to recover. The deficit takes years to get smaller. Here was the COVID deficit. Here we are today. We're still way out past the historical distribution of normal deficits. So that's something that I think is the biggest elephant in the room right now. Everyone can see it. Everyone knows the deficit is too big, and nobody knows what we're supposed to do about it. Yeah, I know there was a new House Speaker announced yesterday, but they haven't had one for the last couple of weeks. And if you look at the guy that they just picked, That guy has been voting against sending more money to Ukraine. So and I don't care either way about that. Not to present my opinion on it, but to present to you the rift in Washington, and the things they are fighting over are the deficit. So, we've been in this tightening cycle for 18 months. That's about 2/3, 3/4 of how long a normal tightening cycle is for the Fed. Usually it's about 2 years from when they begin hiking to when they stop. And they began hiking in March of last year. So we're getting really close to that period of time where historically they're just kind of done. And it wasn't really until the last couple of months that we finally started to reach what is considered tight financial conditions, as represented by this line up here. When these lines are above zero, they represent quote unquote tight financial conditions. This is the federal funds rate versus CPI and PCE. So that you can see it's been a long time since we had interest rates this far above CPI, right? And you can see it's been basically since the GFC. We had loose financial conditions for that entire time, minus a brief period in 2018 when we were running quantitative tightening. And we all know how that ended. It ended with the Powell pivot, right? The famous Powell pivot in early 2019 when he decided that they were done raising interest rates and trying to tighten. Well, we've now tightened up beyond that point relative to PCE and CPI. And it's taken 18 months to really get up there, right? Most of last year, conditions were tightening, but we were still below zero. We were still in a historically loose environment, even though the Fed was raising 50, 75 basis points every 6 weeks. It wasn't really until this year, until like April, May, June, July of this year, that this value started to represent tightened financial conditions. And I think that the next 6 months, 9 months, we're really going to see the effects of this start to play into the markets. So, bounced around a lot of things we've looked at. Bitcoin's currently at 33,800. The next spot higher in terms of, high time frame resistance, it's kind of up here. It's around 37.4. I do think that it's extremely likely that Bitcoin comes back down and finds this prior level to look for it as support before it goes up for the next leg. I do think the next leg is also more likely than not. I don't think that it is as likely that this is just some big liquidity hunt for a move back down to the bottom of the range. That is possible. And if we see price action get below this level and start acting structurally like it wants to go lower, the way that the NASDAQ structurally is acting like it wants to go lower, lower highs, lower lows. If we start to see that below this blue line right here, well, then we'll have our answer and we'll have to start looking down here again. But I think it's more likely, I think we have better odds because of how long it was, because of how many months we spent below this level and the amount of times that we tested it. I think it's more likely that we have this going on and that we come down, we test it, we bounce up, and we at least get up into the high 38s before we find out where Bitcoin's actual top is. But as I have expressed to you guys on this channel before, this is not news. If Bitcoin gets up into the retracements, and if TradFi doesn't necessarily look any better, and if the economy still looks like a recession is highly probable in the next few months, then I think that you have to consider this area a major zone of danger for Bitcoin, for it to roll over and not to go much higher than this at all. I think that's very possible. And it's certainly not an outcome I want. But as we talked about an hour ago, Bitcoin hasn't even really put in a retrace for this bear market yet. And the place that I just circled is that spot, right? Above the 50% mark on the fibs. These are the retrace levels. I don't even think we're going to get up in here. I think it will struggle to get above these areas. But if it gets up into there, The halving is next year. If you're a halving cycle enthusiast, Bitcoin has never broken out into a new bull run until after its halvings. So that argument works against you. We've got the elevated risk of recession that has not gone down, despite the fact that GDP was really strong today, which we didn't even talk about. But the elevated risk of recession highly suggests that the top is in for Bitcoin for this cycle already, and that we're not going to just go breaking out into all-time highs. So I think that it's fair to be rational here and to be pragmatic and to just take this level by level. There's no reason to think that, to call for 60K Bitcoin from here, or to think that, we're in some new dynamic that breaks all the prior cycles to the upside, while real rates are at the highest level they've been in 15 years. Those things just don't make sense to me. What are my thoughts on that GDP number? My thoughts are that it's a big number. There's not really much to say about it. GDP is 8.5% for Q3. Real GDP is 4.9%. But I think that could be the peak of growth. And really, we have a lot of periods in the past where we've gotten like good GDP spikes right before recessions. It just doesn't always mean anything. I think it's clear the economy has been stronger than people anticipated. But as you guys know, as we've educated ourselves about on the channel here, the recessionary process takes a long time to play out, and the economy can look good until it suddenly doesn't. And we're in the it looks good phase. But it's slowing down. And I haven't even shown you guys this chart, but we'll end it on this. Here is the chart of job growth for us right now. Here's the black line. This is non-farm payroll job growth, and it has been updated with the most recent figures. We're 12 months into our yield curve inversion. This is our lone example of a soft landing, and this is the period of time when labor began to accelerate from here. You see that? And we are currently trying to maybe do that, but we are also still in track with the recessionary trend, which is the gray line. So it's really too early to say. I think we need a couple more months of prints, and they need to be more decisive, not just going sideways, for us to really know if we're starting to print a soft landing and we're deviating from that recession framework. But like I said, still need more time for that. And while labor looks good, other things really, really don't. This is business loan creation. Looks like total dog shit. Here's bank loan creation. Looks like dog shit. Very low. So I'm not really sure what's going to go on. And if we look at credit, versus all recessions, all this spaghetti on here, these are prior eras. You see them down, they're listed at the bottom of my screen. 1948, 49, 53, 54, 57, 58, 60, 61. These are recessions, right? All the recessions, not counting COVID, because it just breaks all the charts. Back to 1948 and then today. And what you can see is between business loans, consumer loans, real estate loans, and all bank loan creation, relative to recessions, our current level of loan creation is abysmal. Business loans, we are below 70 years of history of business loan creation before recessions. This is us right here. There isn't a single line lower than where we are right now. Consumer credit, there's only two other eras, 1981-82, which was Volcker, and 1990. Those are the only two times when consumer credit was growing at lower than a pace than it is today before a recession. Real estate loans, there's only one other era, 1957, where real estate loan creation was worse than today in a pre-recessionary window. Total loan creation, same story. We're all the way at the bottom. So when you think about an economy, when you think about how the economy is powered, it's powered by two things primarily, to keep it super simple. It's powered by income spending and credit spending, right? Credit creation. That's the primary drivers of consumption, and consumption is about 70% of our GDP. between people's incomes and credit creation. Well, if credit creation, as you have seen on my screen here, has been completely choked off, this is choked off credit. It is basically at zero growth, and it's below every prior era that I have data for. So if we have choked off credit, then all that remains is labor. All that remains is job growth, job creation, full employment. So we really do need to keep an eye on the labor market and make sure that it stays robust and that it doesn't begin to just fall and disintegrate. There's been signs of weakness. We've looked at some of them together, but it is holding up so far, and it needs to hold up because credit is done for, and credit will not begin growing again until rates come down. So we're in a tricky spot. Probably need another few more months of data, maybe another 2, 3, 4 months, and really see where this line starts going before we know a little more. But we're right at that apex point. Would crypto help with tax rebates? I'm not sure about that. All right. So that's it. That's where we're going to wrap up today, guys. Make sure that you're subscribed to my channel. Make sure that you hit the thumbs up button for me. Share this video around with your friends and get the word out. That like button is the best way for you to support me. If you'd like to know when I go live, make sure that you are subscribed and enable that bell icon, the notifications. It'll tell you when I post the video, usually a day in advance, and then it'll tell you when I start the broadcast, so you can make sure that you're here for my broadcasts. Love that you present in Tableau. Dude, this is my software of choice. This is what I build all my charts in. I have a lot of data in here. It's hard to choose what to look at. But yeah, it's great software. It's a little expensive, but I've used it for years. It's just it's what I'm used to. But yeah, keep an eye on the market. Keep an eye on what Bitcoin is doing. Don't be surprised if we come down and test 31K again because of this really clean breakout and the fact that it was a resistance level for so long. And if we actually do find it as support, which I think is exceedingly likely the longer that we stay up here, then the next stop to look for is probably 38,000. You know, you could mark a little midway point in here, which is basically where we stopped at, and say, okay, maybe 34.5, 35 is a little juncture point on the way, but 38 is probably the next stop. And if we get up to there, that's a place where I will probably want to de-risk myself. For me personally, this is not advice. This is not soliciting for you to do anything. For me, I am probably going to de-risk some of my risk asset holdings if we see Bitcoin get up into this area, and especially if we see alts start to move, because that would suggest to me the end of a cycle and the late altcoin season rotation that we get at the end of all of them. So that's kind of what I'm looking for, and we'll talk about that more next week. We'll see kind of how this played out. We will do a stream next week. No more 2-week waits. We'll do another one next Wednesday or Thursday. I'll figure out the date and I will send the link out 24 hours in advance. So we won't wait quite as long, and maybe we'll be able to have more interactive conversations, and I won't feel like I got to do like an hour diatribe. So that's it. I see BCB in the chat. What's up, my guy? See a lot of my friends out there. Thanks for hanging out with me, guys. Thanks for supporting my stream all this time. It really means a lot to me. It motivates me to come do this and talk to you guys, that you find value in hearing my thoughts and looking at the market with me. So that's it. Take care of yourselves, friends. Go outside and touch some grass. Take care of your families. And we will chat in 1 week's time. Cheers, everyone.